And it's a great honor each year that I get to introduce kind of the keynote and the chairman of our conference. So this year, I have the opportunity of welcoming Tom Rampula again. I was telling him before, I think this is the 4th or 5th time he should start inviting me to holiday parties. So for those that don't know Tom, he's the managing director at Vanguard Financial Advisory Services. He is responsible for divisional strategy, oversees the business. He has relationship management responsibilities, daily operations responsibilities, and he's responsible for more than 50,000 US-based financial advisors who entrust nearly $2 trillion of their clients' assets to Vanguard. So Tom, with that, I join you to welcome us.
Thanks, man. You can just give that to Greg.
I'll get you.
Yeah. Welcome, everybody. Good morning. John, thanks for the introduction, and thanks for the kind words about Jack Bogle. I've known Jack for more than 30 years, and he had a profound impact on my life and the lives of millions of other investors around the world. Truly a remarkable legacy. However, it is a bit ironic that we're recognizing Jack today at an ETF conference. While Jack was an indexing pioneer, as John said, and a staunch advocate for low-cost investing everywhere, Jack wasn't particularly fond of ETFs. He was concerned that they would encourage short-term trading, so he favored the traditional index mutual fund instead. It's probably not surprising to many in this room. You've heard Jack being pretty vocal about that. Probably not surprising also that Jack, for a long time, felt that financial advisors were unnecessary. He would say to me, Tom, all you need is total stock market fund, total bond market fund, put them together, no advice needed. We never got into the details of what percentage in each and why we're not using international or anything like that, but that was just a detail to him. He felt that most financial advisors were nothing more than salesmen. By the way, he didn't really care for the sales profession either. In the early days when I first started Vanguard, Jack was in charge. We weren't allowed to sell anything. We could educate, but if you used the word sell and he caught you, you had to put $1 in a jar outside his office. That's a true story. Jack's views on ETFs, financial advice, and the sales profession became abundantly clear to me during a chance interaction I had with him a little more than 15 years ago. It's about 5 or 6 years after Jack had retired from Vanguard. We just launched our first ETF, and we were starting a business working with financial advisors. You can see the distance between his retirement and our new business in ETFs and working with financial advisors. I was boarding a plane from Philadelphia to Boston, and lucky me, I got to sit next to Jack on the plane. And I've known Jack, like I said, for a long time. We started chit-chatting, and he said, hey, Tom, what are you up to now at Vanguard? I said, I took a role in a newly formed division serving financial advisors across the industry. He looked at me, not that happy over his reading glasses. He said, well, what are you doing in this new business? I said, I'm head of sales, Jack. Yeah, you're starting to see where I'm going with this now. And then he said to me, Tom, as far as I know, we don't pay for distribution. He's like, we still don't pay for distribution, right? I said, no, Jack, we don't pay for distribution. He said, so most financial advisors wouldn't use our mutual funds. What are you selling? I said, of course we're selling ETFs, Jack. He looked at me again, his face turned bright red, and I just realized that I admitted to Jack Bogle that I was head of sales for ETFs selling to financial advisors. You know, he was fuming, looked at me and said, well, I hope you're happy with the career choices you made, Tom. And he proceeded to stare straight ahead for the entire flight to Boston, not say a word to me. This is a true story. That flight's only 45 minutes, but it felt like 45 hours. Didn't think that was a career enhancer. Jack subsequently has spoken to me, and I think we're all good. Despite Jack's views on ETFs, I am certain he'd be supportive of a conference dedicated to low-cost indexing, education, and better outcomes for our advised clients. As John mentioned, the theme of this conference this year is Changing Times Solutions Define. I can't think of a better theme given this incredibly dynamic environment that we're in today. Think about it. From geopolitical changes, to central bank policy changes, to advances in technology that impact our lives every day, we're in a world of constant change and uncertainty. But fortunately, we've got a lot of experts here to help us sort through the issues so that we can excel in our professions. whether investment strategy, portfolio management, or surviving in an industry that's seemingly at a race towards zero. Yesterday we heard from Rick Edelman about building a practice, a successful practice in this environment. We also had a rare treat, very rare treat in America these days, a bipartisan discussion on the US political landscape. Well, we're going to hear from experts. The experts are going to help us out, right? And we're going to build on that momentum. We're going to have sessions starting today that will help us thrive and adapt in this ever-changing environment. From Soul Cycle to Moneyball, we're going to learn a lot from our speakers. Which brings me to our next speaker. I'm pleased to introduce my colleague and friend and Vanguard CIO, Greg Davis. Greg's been with Vanguard for over 2 decades and is an investment professional. He started out in our fixed income group, moved on to be our Asia Pacific CIO, and finally took over as global CIO in 2017. Greg's team manages more than $4 trillion in assets under management, active and passive, fixed and equity portfolios. Greg's going to talk to us today about Vanguard's economic and market outlook, but importantly, the role bonds play in your client's portfolio. Please join me in welcoming Greg Davis to the stage. Oh, boy.
Thank you, Tom, and good morning, everyone. It's truly a pleasure to be here at the Inside ETFs conference with you today. Hoping to provide you an overview of Vanguard's market and economic outlook, and also offer you some thoughts in terms of the role of fixed income and how it can serve your clients well in their portfolios. I've been on the road meeting with a variety of clients, institutional investors, retail investors, as well as financial advisors. And one of the top questions I get is, what's driving the volatility in the markets? That's typically been followed by, how did we find ourselves in or near a bear market during the fourth quarter of 2018? And then for individual investors, the follow-up question and the kicker is, and what should I do about it? Well, it's certainly not an easy environment for you to navigate. We have geopolitical uncertainty, we have a flattening yield curve, we have trade tensions that seem to be looming, we have the uncertainty in Washington, D.C., but here's the good news. The good news is that the principles of good investing still hold. Today's market conditions open the doors for conversations with your clients about sticking to the original plans that you and your clients created together. Uncertainty in the markets reinforces the value that you provide as an investment expert and behavioral coach. In other words, your clients have a distinct advantage during tumultuous times, and that's you. Our inspiration for this year's outlook comes from none other than the Philadelphia legend, Rocky Balboa. Yes, he's fictional, but to the people of Philadelphia, he's very real. His down but not out attitude truly aligns with our US and global economic outlook. Even when Rocky wins the fight, he takes a pretty ugly beating along the way. Now, we're not expecting anything as dramatic as a boxing match, but concerns about slower growth and rising rates make 2019 a potentially challenging year for investors. First, if we take a look at global growth projections, we're expecting growth to slow down this year because of tightening financial conditions, tighter monetary policy, and just general uncertainty in the marketplace. Part of it is geopolitical. We're expecting growth in the US to slow to about 2%. We're expecting Europe to slow down from 1.5% to about 1%. And there's also going to be a slowdown in China, where we're expecting 6% GDP growth, but for a period of time, we're expecting it to slow down even further. Clearly, trade tensions bring a lot of uncertainty to these figures, and we've actually increased the odds of a recession in 2019, according to our model, from 30% to about 35%. But we still believe the odds of, or the probability of a recession in 2019 is still unlikely. However, as we go into 2020, we see those odds increasing. We see the odds of a recession in 2020 rising to 40 to 50%. But it all depends on how high interest rates go, how muted global growth becomes, and how policy uncertainty ultimately plays out. Second, if we were to take a look at inflation, we expect it to remain relatively steady. 2% in the US, 1.5% in Europe, and about 1% or so in Japan. Now clearly, an escalation in trade tariffs, if we see a spike in oil prices, or if we see wage pressures starting to emerge, this could change this picture. But we believe that it's unlikely we're going to see a steep rise in inflation anywhere around the globe this year. And finally, when it comes to interest rates, we do expect the Fed to raise rates once more this year, most likely at the June meeting. And we're not expecting any movement whatsoever out of the ECB or the Bank of Japan, thereby widening the gap between the Fed and other developed markets. Against this backdrop, we have slowing economic growth, stable inflation, rising rates in the US, and volatility has returned to the markets. And we're expecting it to stay throughout 2019. We have to remember the last year, the last quarter, and in 2018, we saw 20 days last year where the S&P index moved by 2% up or down. That sounds like and even feels like a lot until you pan out and take a look at the market movements over time. Here's the volatility index, also known as the VIX. You see the peaks and valleys of volatility over the years, over the past 30 years, and I can tell you personally, I've learned lots of lessons being in the markets for the last 20 years or so. And if you follow this progression, you'll see the dot-com bubble, you'll see the tech wreck, you'll see the global financial crisis in 2008, 2009. And we also saw a significant rise in volatility towards the tail end of last year. But we've enjoyed a period of relative calm for a number of years. As I mentioned, 20 days last year where the S&P moved by 2% up or down. But how does that compare to prior years? On average, you'll see about 16 days where we get a 2% move in the markets. It's about a quarter of what we saw during the global financial crisis and a fraction of the volatility that we experienced during the dot-com bust in the early 2000s and the European debt crisis in 2012. But just because it's normal doesn't mean it feels good for your clients, especially when we've been having and sailing through relatively calm waters. By comparison, in 2015, there were 10 days where the equity markets moved by 2% or more. In 2016, that number dropped to 9, and in 2017, it was 0. But we have to remember, what else is contributing to this roller coaster ride and feeling was that the volatility in 2018 was compressed into a relatively small window. 60% of those 2% moves happened during the last quarter of the year. Here is where the uncertainty advantage really comes into play. This means your role as a behavioral coach is going to become exceedingly important in the months to come. Our internal research has shown that advisors can add 150 basis points, 1.5% in value, to your clients' portfolios just by helping them stick to their plans. And with return projections trending lower, every investment dollar absolutely counts. This chart is taking a look at our 10-year equity projections. The red is our current projections, the black is where we were 5 years ago. Over the next 10 years, we expect US stocks to generate about 5% in annualized returns. International stocks, where valuations aren't quite as high as the US market, we're expecting them to produce a median annualized return over the next 10 years of about 7.5%. Now, if you look at the graph, you can see that they're lower than where we were 5 years ago, where we were expecting close to 8% returns, both in the US markets and the international markets. So with equities expected to deliver more muted returns, now's the time to make sure you evaluate the role in fixed income in your clients' portfolios. We see bonds as having two purposes, a dual role. One is for ballast, the other one is for returns. Fixed income is our traditional hedge against equity market downturns, and rightfully so. No matter what the scenario, rising rates, falling rates, volatile markets, periods of calm, bonds are a powerful diversifier. If you look at the past 30 years when equities are struggling, bonds tend to help offset those losses with modest gains. This graph shows the performance of various asset classes during the worst decile months in the equity markets. The black are those categories posting negative returns. All equities, with the exception of high yield, which behaves like an equity at times. But during these lowest return months in the equity markets, high quality bonds across the board eked out some gains. Not significant gains, but a portfolio that includes bonds will counter or temper equity market losses. The end of 2018, from the peak of the S&P index on September 20th through the trough on December 24th, provides another great proof point for the role of fixed income as ballast. Both October and December fell into the worst decile months in the U.S. equity returns since 1988. While U.S. equities were down nearly 20% and international stocks were down 13%, international hedged bonds provided us modest gains, and treasuries provided a return of nearly 2.5%. And the second role of fixed income that is too easily overlooked is the returns that they can deliver for long-term investors, even in a rising rate environment. Fixed income in a rising rate environment is not a bad thing, so long as your time horizon is longer than the duration of the fund, because the maturities will be reinvested at higher yields, providing higher returns to your clients. Our 10-year outlook pegs returns at around 3% for US, non-US, as well as treasuries. While equity market projections have diminished over the past 5 years, fixed income return projections have actually increased slightly, making them a more meaningful contributor to your portfolio's returns. The interesting thing to see, though, is look at cash on the far right. It's more attractive. We see expected returns on cash going from 2% 5 years ago to 3% today. Now, if you couple that with lower expectations when it comes to the equity markets, you can see that the equity risk premium is starting to shrink. And for your clients who have a shorter time horizon, consider high quality, shorter duration approach, given how flat the yield curve is. Just think about it. You can earn 95% of the yield, approximately 95% of the yield of a 10-year treasury by investing in a 2-year treasury. That's almost the same amount of yield with a quarter of the interest rate risk. Regardless of the duration, keep in mind 2 key factors that go hand in hand when you're evaluating fixed income. One is cost, the other one is risk. Whether you use an indexed ETF approach for factor tilts like credit, term, high yield, or take an active approach to try to outperform a benchmark or peers, costs matter. This concept comes to life when you look at where alpha is coming from among different categories of bond funds. We looked at over 1,100 active bond funds and ETFs. We're looking at the average monthly returns for corporate and intermediate term government bond funds. These are gross returns, though. The corporate sector is clearly more diversified. You have term, you have credit, and you have manager-generated alpha, driving almost equal shares of the monthly returns. On the government side, it's what you would expect. You have term or duration, and managers account for the bulk of the returns. Now, you'll also see on the government category a marginal but statistically significant portion of the returns that's actually attributed to credit. And this tells us that some of the managers are straying away from their mandate in the search for yield. Now, keep your eye on the green portion of this graph because it looks very differently when fees are taken into consideration. I know you're shocked. The Vanguard CIO is talking about costs, but bear with me for one quick second. Most of the value that managers generate disappears. It's erased from the government bond category completely, and it's significantly diminished among the corporate space. High cost, active fixed income will significantly erode the returns, especially in a low return environment. Choosing persistently outperforming funds is not easy, but low costs will increase the likelihood of your success. Now, let's take a look on the other hand, and that's risk. My daughter Peyton, she's a gymnast. I've spent many, many hours watching her compete. And I can tell you that the scoring in gymnastics, if you don't follow it closely, it's, I believe, more complicated than what goes into our Vanguard capital markets model. Scoring is based on difficulty and execution. Highly complex and difficult routines receive a higher starting value. Execution with minimal mistakes and a demonstrating artistry are rewarded with fewer deductions. Trust me, it's nerve-wracking watching your kid flip, spin, or dismount on a 4-inch wide balance beam. But the thousands and thousands of hours of practice are a powerful counterweight to the risks involved. But just like investing and just like gymnastics, successful investing requires taking reasonable risk with minimal mistakes. Unfortunately, I've seen some bond managers stray away from the sweet spot, specifically chasing yield in the hopes of generating more returns. At Vanguard, we believe in smart risk-taking. We're positioning our active funds to strike when the opportunities present themselves and stepping back when conditions are less favorable. We view this as an important part of fixed income, which should behave ultimately as ballast in your portfolio. Low cost allows us to take advantage of the entire scope of opportunities because we don't have the high hurdle of fees to overcome. If you're implementing an active strategy, carefully assess how the manager intends to generate the additional returns. Our approach to active credit, we've been positioning to be more defensive. We're expecting the yield curve to steepen as the Fed gets closer to the end of their tightening cycle. We think that credit will hold in the near term, but we do see darker clouds on the horizon due to slower economic growth, tighter monetary policy, all of which will have a negative impact on credit over time. I'd encourage you to use the same critical lens for your clients' portfolios. Will they be comfortable with the level of risk that they have in their portfolios? And remember, be careful about pushing too far in the defensive portion of your portfolio. Investing is not for the faint of heart. Many of your clients may have forgotten what it feels like to persevere during a downturn, or they may be expecting higher returns than what the market can reasonably deliver. And remember, everyone feels like a genius during a bull market. But during periods of stress and low returns, a calm head and core fundamentals absolutely matter. These are the times that the uncertainty advantage benefits your clients the most, where you provide that measurable value. You're their emotional ballast during these uncertain times. As our friend Rocky Balboa would say, it ain't about how hard you hit, it's about how hard you can get hit and keep moving forward. Thank you, and enjoy the rest of the conference.